Hello everyone, welcome to Just Invest Today. And in today's video, we're talking about Cathie Wood's Ark innovation. Her ETF has been getting killed. Is Cathie Wood done? Is it over for her? Is she getting exposed? Because man, this has been a huge tech sell-off. And man, Cathie Wood is like the staple of like tech and innovation, everything going for like the new generation of companies. So it's super key and super important to see what's happening with her fund because people are trying to say that she's getting exposed because this huge tech sell-off. So before we really get into this, please like this video, subscribe to my channel. I'm always providing you with new content, man. So like it, subscribe, man. Click it, click it, click it. So let's get into this video because man, oh man, look where her stock was. Remember, this was during the whole March crash. It was at $37 and went all the way up to 156. It's almost like what? A 248% run up. Crazy run up, right? And I think what's happening here is that her ETF got way too ahead of itself. And now it's crashing from 156 all the way down to $81. That's a 48% decline. So that's what's happening in the market now, and Cathie Wood she has to come out and say why this is happening, what she's seeing in the market, and we're gonna react to one of her videos, right? Talking about what's happening in the market, because if you're not noticing, the tech sell-off is real. Everyone is switching from tech into value plays because remember, the Fed is increasing interest rates. They're probably gonna stop bond buying, so everyone's scared of what's gonna happen. That's gonna be at a higher price. Like you're gonna have to pay higher interest rates on debt, and if you're not making money, for a company that's not making money, that can have a huge implication on your company. So people are kind of watching out for this. Dennis Hong had an interesting tweet. He just came out. Look at all these negative stocks, man. Been taking a huge hit, man. Upstart, Coupon, Metacarber, Libre, Billy, Sprout, Plantair, Carvana, Crowd, Shopify, Fartech, like all these stocks are getting crashed 20%, 70%, 30%. They're just getting killed in the market right now. And then when you go back and you see what's happening to all the value plays, look at all the value stocks up. Clorox, Hershey, Kraft, PepsiCo, like all of these stocks are just, they have so much value. They're looked at as one of those companies that are just going to stand the test of time. Like they're not going to go anywhere. Like nothing you can do is going to make it bankrupt or default on debt. Like there's nothing you can do to penetrate these brands. And they can always raise prices because they have pricing power. So that's how you kind of stop inflation, stop interest rates. So people are actually looking into these companies more, and that's what you're seeing. And it's a huge rotation from tech with no probably earnings, just crazy revenue growth but no earnings, into these solid value plays that are just steady compounders for 100 whatever years. These are the companies that have been in power for like 100 years. So that's what we're seeing. So let's get into this video and what we're seeing with Cathie Woods, because she has to come out and defend her position because man, people are just running out of her fund. They're escaping it. They see the burning house and they're just running out and they're saying, no, we cannot be in this. Let's listen to Cathie Wood's explanation on what's happening in the market. And let's see if we can kind of refute it. We kind of see where she's wrong and where she's right.
Coronavirus crisis started, I have been giving weekly or monthly updates. Now, why have I done that? For a couple of reasons. During the coronavirus crisis, when it hit, it was clear to me that the headlines that people were reading, generally, both investors and the general public, were not capturing what was really going on in the economy. There were a lot of economists, famous economists and others, strategists as well, who were looking at the economy shutting down and were basically preparing people for a depression, if you'll remember. And you can go back to those videos. In the early days, they were called Stay at Home with Cathie, and then we switched to In the Know. And as you know, back then, I was very focused on the possibility that this was a shock from which we would recover very quickly.
See, and this is what she's not getting. She said it was a shock and it recovered really quickly. But she's not showing you the other side of what happened during that shock. Remember, this was actually a real situation. Like this kind of came out of nowhere. So when everything shut down, this actually really did happen, and it really affected a lot of businesses. You can't say it didn't affect a lot of businesses and it was just easy to see like the come up. Like that's just hindsight bias. Like this really did have an effect on a lot of companies, and a lot of companies, yes, their profits were going to get killed, they're going to get hurt, especially if you're a brick and mortar. But yes, there was a lot of benefit too for like the Facebooks to the Zooms. But she's not seeing the other side, which is the Fed came in and injected so much money. I think that the stock market would have crashed 50, 60, 70, 80%. Federal Reserve didn't come in and say, wait, hold up. We are putting billions of money into the market. We're going to hand out money to the people. We're going to do extreme purchases of equity, of bonds, of mortgage-backed securities, of debt. Like, you don't understand. I don't think she understands that this bounce back probably wouldn't happen. It probably would have took maybe a year to recover, like other crashes. Maybe took a year, maybe 2 years. But no, since the Federal Reserve has the power to kind of stop that, that's what's happened, and that's how it bounced right back up, because people were happy and they seen the government intervention, and they're like, oh shoot, let's get back in, because the government is not going to allow these companies to go bankrupt and the economy just to die out. So she's kind of hiding that fact that she probably, I don't know if she knew, but this wouldn't have happened if the Fed didn't come in to save the day.
That turned out to be a correct call. And every week in the beginning,
it was only a correct call because the Federal Reserve made it a correct call. If it wasn't for that, it wouldn't have been a correct call. We would have had to see a year, 2 years, you never know, right?
And then monthly, I was delving into the economic reports that were coming out and into the earnings reports and pulling out evidence that supported or refuted that point of view. And that worked. Well, today we have a very different point of view, once again, about what's going on out there. To alert you to a blog that I wrote in mid-December. It's on our website. And it goes into why we believe that innovation is in deep value territory. And goes through.
I honestly don't even think she knows what deep value is, man. If you if you really look at the companies she owns, like look what she's talking about, deep value. We're gonna look at her holdings. These are the companies in deep value. Tesla. She says Tesla is in deep value. This company's selling at like a 300 PE, and she's saying this is deep value. Like Tesla, you gotta remember, even though we love Tesla, we love Elon Musk, it's a car company with not big margins. Like you can't say it's just gonna take over the world, where there's Volkswagen, there's BMW, there's so many companies coming up with electric cars as well that are probably gonna do the same thing as Tesla, even though they have a cult following, which is amazing. It's still a car company. What people think that the Tesla company is gonna do, like far and far away from what the real valuation is today. So that's not deep value. Zoom, man, like Zoom. Come on, like, is Zoom really in deep value? Like, how are they gonna compete with all these, like, Google, Facebook? Like, all these companies can do Zoom. Like, they're still selling at above, like, 12, 13, 15 price to sales. So it's not even in deep value when you really think of it, unless you think Zoom is gonna make that much more money ahead. Like, unless you think Zoom is gonna be, like, the superior company that can not be overtaken when it comes to, like, talking on the web. So... And Teladoc, like, these companies are not really profitable. Teladoc, Roku, Coinbase, I think Coinbase is one of the stocks that I think are in deep value, honestly. Not deep value, but value. So, the other companies like Roku, Teladoc, Zoom, Tesla, it could go either way, but man, they're not deep value. Like, deep value is buying a dollar bill for 50 cents. Like a cigar butt investing like Warren Buffett. That's deep value. These companies are not deep value. There might be maybe value, but deep value, those are, like, deep value means a lot.
Through and refutes a lot of what we believe are the myths out there about innovation. We believe that COVID-19, the coronavirus crisis, accelerated the shift towards the innovation platforms around which we have based all of our research. And I'm going to give you a few examples of that in a minute. I do want you to know that, of course, we've been through a very difficult time since the significant rotation from growth into value started nearly a year ago in mid-February.
So true, man. Growth has been getting killed. It's all about value right now. And look at this article. ARK Holdings executives offload $13.5 billion in stock. So her own partners in her company are offloading stock. They're seeing what's happening right in front of their face. They're not buying into the company at the prime time, because this right now would be the prime time to buy when your stock is down 50%, right? But that's not what you're seeing. You're seeing maximum outflows and no inflows. Look at this. This just shows you that this could go either way. Like, it's either Cathie Wood, it's extremely right. Like, what's your opinion? Do you think her stocks are in deep value territory right now? Or do you think the sell-off is like justified? Like her companies were like above realistic market prices. Everything way too ahead of itself. The valuations are just way too sky high. And that's my opinion. I think the valuations are way too sky high, but she thinks it's in deep value. And then Cathie Wood basically talks about how the algorithms are wrong because they're focused on interest rates, inflation, and valuation. So the algorithms are actually what's generating all this market sell-off, which kind of opens my eyes again, that the institutions are not even running sometimes their funds. It's all about the algorithms and what they're seeing in the market, and it's all about momentum, which is a good thing for us as retail investors, because think about it. This is how we get into these companies at cheaper prices, because the institutions are going to cause these mass sell-offs, and then when we get in at these cheap prices, we can actually get in cheap, and then once the algorithms or once the institutions kind of get back into the company, we're going to see another boom cycle of these stocks going crazy in the market. So people, the institutions, the algorithms are thinking about the tech sell-off again. They're thinking about the bubble which happened in 2000. So that's why they're super cautious. And the algorithms are seeing this in the market valuation. So they're getting out of all of those stocks and going into value stocks or value stocks. And that's what Cathie Wood is talking about and comparing to. But she's saying that Zoom, Teladoc, they were actually producing real earnings, like the real, like, lively earnings with good future potential, revenue growth, gross margins. But companies back then in 2000, which the algorithms are actually selling off and preparing for, those were like the pets.coms and all these random .com companies that weren't producing anything, right? And they had no backing, and it was just all momentum back then. So she's comparing it back to then, and that's why the algorithms are selling off. But in today's market, that's not true today, as Teladoc, Unity, Roku, Coinbase, they're actually producing real money, real earnings. So she's saying that it is not accurate what the market is doing today. But she's not seeing that valuations matter. No matter, I agree with her on that point, on that topic, but you still have to remember valuations matter. If you're paying for a company that you have to pay 1,000 PE for their future earnings, it's going to take you 1,000 years. That's how you think about PE. It's going to take you, if a company's at a PE of 1,000, it's going to take you 1,000 years to get your money back. If you were thinking like a business owner, like you bought the company. The valuations matter, and she's not seeing this right now. She's not opening her eyes to the fact that valuations can get ahead of itself. So that's why you're seeing a sell-off, and that's why I don't pretty much agree with her, because yes, her companies can be producing real earnings, real innovation, becoming amazing companies, but at the end of the day, the market valuations matter to the company and what the appropriate price the company should be at, right? So that's what she's not seeing. So I can kind of see a sell-off continuing maybe into the mid-year, and then you can see a kind of consolidation, and then a kind of re-jumping or reconfiguration of the market of the companies that she owns. Who knows what's gonna happen this year, because this year has been pretty crazy. So tell me what you think about this video, and what do you think about Cathie's strategy, if she's right or if she's wrong. What do you think about the whole ARK Innovation crash and their stock crashing, man? Please like this video, subscribe to my channel, and I'll get back to you in the next video.